Hi, it's Kim. I'm going to take a look at the Maximum Potential Calculator from the Truth Concepts suite. And we're going to talk about income today and how it impacts your prosperity. Most importantly, the ability to save, which all of us think we don't have the ability to do. But if you can simplify your savings, automate your assets, we can install faith in your finances. So let's dig in. You'll notice I've got a 30-year period of time. We're looking at a 30-year-old earning $100,000 of income. Could be $1 million, just add some zeros, but this is easy math to do. When we see that is actually $3 million over time. Pretty hard for a 30-year-old to imagine that in many cases, but that's the maximum potential that they have if they didn't have anything else to do with money, like, pay taxes. So let's take a look at just taxes in general, everything, federal, state, city, you name it. About 30% of the income, guessing. Debt payments, mortgages, etc., probably another 30%. And you can see what's happening here is that even though those total numbers are only, say, $900,000 in this case, because we couldn't earn money on those dollars, this is called opportunity cost. Let's say that we could have been earning $4. We've lost about $1.7 million each. So this is what this big red is down here in our Christmas tree turned sideways picture that we have. So if we had 32 taxes, 32 debt, and another, let's just call it 30 to lifestyle, meaning 10% of the money was going to savings, what that would look like, no raises or anything, just 100 grand the entire 30 years, 10% the entire 30 years, is savings of 583,000, which is only 10 more years of income. And when we acknowledge the fact that we're probably going to get some raises, maybe even shift jobs, but let's just go with the simple aspect of getting raises at, say, 3%, then we're looking at compounding out all of those numbers. So our last year of income is in the $235,000 range, and still only about 5 years of income that we have saved by doing 10%. So amazing. Now, what the typical financial planning community says to do is go earn a higher interest rate because more risk equals more reward, right? Like everybody says that, everybody thinks that, but is that really what happens? 2008, 2009, I don't think so. But let's just pretend that we could get 10%. Now, this is a net earnings rate. In other words, after tax, after fees. If we could get 10, now we have created about 66 years of income. Sounds pretty good. But what's going on with that 10? I mean, that's really like a 15 or 16% return every single year without a bobble. Is there a safer way to build our savings? Let's take that back down to 4 and see what we could do if we could reduce taxes a little bit. Now, I'm not talking about taxes on earned income from an annual standpoint, but more about reducing taxes on our assets. Let's just say we could pull that down to 25% or so. Let's say we could be a little more efficient with our debt. We're always going to have debt. We don't want to be in debt. Big distinction there. But let's say that we can pull the debt down to, say, 20, and now we're saving 25% of our income. And with only earning 4%, we have 17.95 years of income out there. So this is not investments. This is just savings. Now, what is that actually going to look like? Well, if you're a member of Truth Concepts 360, you have a macro that will actually take that money and show it to you on a cash flow calculator. So here what we have is our $2 million number. We have our debt payments and lifestyle still, and we're netting. So this is all after tax. You can see the income play out here over time. And this is that 18 years that we were taking a look at earlier. So this is something that teaches us that it's not the rate of return that matters as much as what we are doing with the money in terms of savings. And when we can simplify our savings, we can automate our assets and install faith in our finances.